This short tutorial demonstrates how to make a financial decision whether to keep or replace a machine. A wide range of financial data will be available for both the existing machine and the proposed replacement. To make the decision, we must consider which data is relevant and which data is irrelevant. Firstly, we will know the original cost of the two machines. In our example, the old machine cost $10,000, while the proposed replacement machine will cost $8,000. The useful economic life of the old machine was 10 years, while the useful economic life of the proposed replacement is 4 years. The current age of the old machine is 6 years, whereas the proposed replacement machine has a current age of 0 years as we have not purchased it yet. Consequently, the remaining useful lives of each machine are 4 years. For the old machine, this is derived from the useful life of 10 years, less the current age of 6 years. The accumulated depreciation on the old machine is 6 years at $1,000 per year, which is $6,000. The replacement machine has not been depreciated as we have not purchased it yet. The book value of the old machine is calculated by subtracting the accumulated depreciation from the original cost. Hence, $10,000 less $6,000 is $4,000. The proposed replacement machine does not have a book value. If we were to sell the old machine now, we would receive $2,500. 4 years from now, neither the old machine nor the new machine will have any disposal value. The old machine costs $5,000 each year in operating costs. The new machine would cost $3,000 each year in operating costs. We have quite a large amount of data available to help us make the decision. We must now establish which data is relevant and which data is irrelevant. The most widely misunderstood facet of replacement decision-making is the role of the book value of the old equipment in the decision. The book value in this context is a sunk cost. A sunk cost is a cost that has already been incurred and therefore is irrelevant to the decision-making process. The book value of old equipment is irrelevant because it is a past, historical cost. Therefore, depreciation on old equipment is irrelevant. As the book value is derived from a combination of the useful economic life and accumulated depreciation, all of this data is deemed irrelevant to the keep or replace decision. Note that all data relating to book value is used for financial accounting purposes and is not used for management accounting decision-making. The original cost of the old machine is also a sunk cost and therefore irrelevant. Note that all data relating to book value is used for financial accounting purposes and is not used for management accounting decision-making. A gain or loss on disposal is the difference between book value and disposal value. It is therefore a meaningless combination of irrelevant, book value, and relevant items, disposal value. Hence, any gain or loss on disposal is irrelevant to the keep or replace decision. The disposal value of old equipment is relevant because it is an expected future inflow that usually differs among alternatives. The cost of the new equipment is relevant because it is an expected future outflow that will differ among alternatives. So, in summary, we can tabulate the relevant information relating to the keep or replace options. We'll consider these options over a 4-year period. 4 years is the useful life of the proposed replacement machine. Over 4 years, the old machine will cost $20,000 to operate, while the proposed replacement machine will cost $12,000. These are future costs that differ between alternatives and are relevant to the keep or replace decision. If we opt to replace the machine, we will dispose of the old machine for $2,500. This is a future cash inflow and is relevant to the decision to keep or replace. If we opt to replace the machine, we'll pay $8,000 for the new machine. This is a future cash outflow and is relevant to the decision to keep or replace. We have now considered all the relevant cash inflows and outflows relating to the keep or buy decision. So the net impact of the machine replacement is a reduction in cash outflows over 4 years of $2,500. Hence, the best financial decision is to buy the replacement machine. This short tutorial demonstrated how to make a financial decision whether to keep or replace a machine.